Well, welcome to everyone, and thank you for joining us from around the world. I think we've got representation from about 49 countries, if I'm correct in saying, which is great. I mean, it shows the true global nature of what we're discussing here. My name's Andy Field, steering committee lead of the Global Equity Crowdfunding Alliance, and today's webinar brings together supporters, members, and followers from GECA, that's the Global Equity Crowdfunding Alliance, EDFA, European Digital Finance Association, and Crowdfunding Insider, to discuss a real central challenge that's facing our industry, and that is how we move from fragmented national markets to a more connected global ecosystem for crowdfunding. So we'll take a brief look at what GECA is seeking to achieve. We're going to hear from leading regulatory experts in the EU, the US, and the UK, and then we'll bring platforms and technology leaders together for a practical panel discussion on how we can overcome some of the cross-border barriers. And then we'll close just by looking ahead to an in-person gathering that we're having in Málaga in Spain in April, hosted by EDFA and GECA, where we'll take these conversations a little bit further. I just wanted to start with some very basic housekeeping. Our speakers are all in the room. Hopefully you can see them on the screen now. If you've got any questions at all during the session, please put them in the Q&A. There's a Q&A functionality there. We may not have time to answer all of the questions. We'll try and answer a few of them, but we're on a well, one of the concerns that we had when we were planning this webinar is that with such interesting topics, our speakers are going to have a lot to say, and we won't necessarily even have time to hear everything that they want to say. But we will do our best, and we'll address that by hosting a series of follow-up webinars if we need to, with more, being more specific on the topics concerned. So please understand that if time isn't on our side during discussions today, we'll delve deeper in the follow-ups. Okay, so with that out of the way, before we welcome our panelists, I just want to tell you a little bit about GECA. GECA was created about 18 months ago, and it was created because the crowdfunding ecosystem has become truly global in practice, but remains fragmented in regulation, infrastructure, and coordination. Now, GECA's mission isn't to lobby for one regime over another. Instead, we aim to be neutral, industry-led network of stakeholders that brings together platforms, investors and founders, industry associations, regulators, policymakers, and tech providers. And our goal really is to foster dialogue, alignment, and practical pathways so that we can attempt to have more cross-border collaboration. I mean, today, a business that wants to raise capital across borders faces multiple regulatory systems, multiple compliance regimes, and often multiple technology standards. Investors struggle to access opportunities outside the home market, platforms face duplicated costs, and deals that should be global remain local. And it's this fragmentation which limits growth at exactly the moment when we need more efficient capital for SMEs, climate projects, infrastructure, and innovation. So this is where the work behind what GECA are doing becomes useful in context. Now, we're putting out a white paper very soon, in the next few days, actually. It's been written on the back of our own primary research, and much of the evidence was harnessed via output from the GECA-led roundtable discussions that took place at towards the back end of last year. And we'll leave you to look at that in detail. We'll send you a link to that paper when it's released. But to suffice to say that what it does highlight is that there is evidence of real cross-border demand. Investors are already investing internationally. Platforms are already trying to scale beyond borders. There is expert consensus and broad agreement that fragmentation is slowing the market and that no single jurisdiction has the complete answer. And it also considers why coordination is urgent, with digital assets and tokenization accelerating change, and more platforms becoming multi-jurisdictional and capital increasingly needing to be flown across borders. So with that context in mind, I'd like to introduce our moderator for the first section of the webinar, Andrew Dix. Andrew is CEO and co-founder of the Crowded Media Group and is extremely passionate about developing the crowdfunding ecosystem. He's also a regular speaker at conferences, webinars, and podcasts across the globe. So welcome, Andrew.
Hey, thank you very much, Andy, for the great introduction. And thank you to GECA for organizing this, as well as Karsten with the German Crowdfunding Association and the European Digital Finance Association, which is a newer group. And I'm happy that they've been created to help support online capital formation and securities crowdfunding. So, Andy, I think what you're doing here in pursuing cross-border securities offerings for exempt markets, which is what we call the United States, is an admirable goal. I do think that we're kind of at a cusp where technology can improve this market. And I want to add that it's always been my belief that the three stakeholders in the industry must be successful for the entire thing to work, which includes platforms need to be profitable, issuers need to raise the money they need for growth, and investors need to see a good return. And I think that we're close in all these, and I think we're getting closer, and I think technology is going to help that. And obviously, I think you agree with me, don't you?
Yeah, absolutely, 100%. I mean, in every conversation that I've had about the subject, that's exactly what comes up. You know, the technology is actually probably already there. We just need to get some alignment on everything else that's going to, you know, to affect how business is done across borders. So I totally agree, Andrew. Yeah.
Yeah, and I think that regulatory clarity, it takes time. Everybody wants it to happen yesterday. In the United States, we're going through a period where kind of digital assets are kind of taking all the air out of the room. But I do think that it's gonna benefit securities crowdfunding in the long run. It's just gonna take a little bit more time. We're almost there. And
Yeah,
I think
absolutely. It's not easy. It's not easy. What we're trying to do is not easy. And we fully appreciate that. But you know, we've got to start somewhere. So, you know, I think this is a great start for us.
We do have to start somewhere. And so on that note, I'd like to do an introduction of the next discussion group that we have here. And we're going to provide a global regulatory roundup. Compliance and regulations is something that I love. Most people do not like it. We're very fortunate that we have three experts here that are going to share perspectives from their own jurisdiction. And I think from my point of view, this is a very important topic. And from the US point of view, our securities regulators just expect you to be compliant under the exemption that you're using, regardless of where you're doing it. And so there is a path there. Again, it just takes time. So we have Robin Sosnow, who is the founding and managing attorney of the Sosnow Associates. Robin is an OG. She's been doing this for a long time. She knows this stuff better than anybody. And so we're very fortunate to have her here. We also have Karsten joining us. As I already mentioned, he's the leader of the German Crowdfunding Association, as well as the European Digital Asset. Something too long here. European Digital Finance Association. And then we have Bruce Davis, who I haven't seen in a really long time. And I have to say, Bruce, you're looking awesome. So we're going to start with Robin here. And Robin, I want you to explain to our audience the securities ecosystem within the United States. Now, I know this is a tall task, but you're very, very knowledgeable in this area and you deal with it every day. So could you explain to our viewers Reg CF, Reg A, and Reg D, and how you can use these exemptions online? And I know insiders typically get too caught up in the acronyms, but I think you're going to do a great job right now explaining it all for our viewers.
Thanks, Andrew. Thanks so much for inviting me to be here today and to speak on these topics from a U.S. regulatory perspective. I really appreciate the warm welcome and introduction. So without getting too far in the weeds, I think I'd like to approach your question by just talking about the Jobs Act, right? The Jobs Act, Jumpstart Our Business Startups Act is where this all started. It passed in 2012, was signed into law by Barack Obama, and then created a series of amendments to existing law, as well as the introduction of new law in the years that followed. So if we approach that sequentially, in 2013, Regulation D was amended to allow for general solicitation. So historically, prior to 2013, if a private company was conducting a private placement, they were prohibited from advertising that offering broadly within the market and particularly on the internet. There were some channels for advertising within closed networks at that time. And in those early days, we were seeing an emergence of platforms that were facilitating closed network private company investing under Reg D. But of course, that was highly regulated and contained some barriers. In 2015, Regulation A was amended and became dubbed Reg A Plus. Back at that time, I believe a Tier 2 offering permitted a private company to raise up to $50 million from retail investors. Reg A was structured in a Tier 1, Tier 2 system. Tier 2 subjected the issuer to a consolidated federal SEC-based review. Tier 1 issuers were subject to state securities regulator review. That framework of Tier 1 and Tier 2 persists today, but issuers are currently permitted to raise up to $75 million under that exemption. That exemption is actually very interesting for larger or more mature private companies who are maybe beyond Series B, Series C, really need a significant amount of capital in order to reach their next milestone, or are looking for an alternative way to go public. Reg A securities, the securities sold in a Reg A offering are unrestricted, so they can actually be listed on a public exchange immediately after the closing of that offering, should a company choose to pursue that direct listing. That's certainly not a requirement. And in fact, none of my clients who have utilized Reg A have actually gone public subsequent to that offering. So it can be used in both manners. And then perhaps my personal favorite of the Jobs Act exemptions, Reg D regulation crowdfunding, which came into effect in 2016 and initially allowed issuers to raise up to $1 million from retail investors. The Reg crowdfunding framework was really high friction when it was introduced, with a relatively small bang for your buck. Right? If you're a private company and you can only raise up to $1 million in capital per 12 months with that exemption, but you are going to be incurring pretty high cost of capital between legal, intermediary fees, accounting fees, if you need a review or an audit, which in most cases do apply, then the exemption was workable, but just not initially highly adopted. So in the years that followed after the introduction of these various Jobs Act exemptions, we saw an amendment come into play in 2020. Very, very, very favorable for the industry. The Reg crowdfunding cap increased to $5 million. Testing the waters became permitted. Crowdfunding vehicles became permitted as well. So just to highlight what that means very briefly, a crowdfunding vehicle is typically a limited liability company that's formed for the purpose of pooling retail and accredited investor capital, so that as you raise in a Reg crowdfunding offering, your investors become consolidated into that LLC, which then sits as a single line item on the cap table of the issuer. This was historically not permitted. This was viewed as an investment company, and there was no exemption that vehicle could fall under. But now, since this rule change went into effect in 2021, crowdfunding SPVs are a workable solution for the messy cap table problem that can arise, or at least be perceived to arise by Reg CF issuers, without giving rise to other potential securities law issues. That said, and just to also highlight, Reg A was increased to $75 million, as I noted prior. So we really saw an uptick in adoption year over year, and I would say post 2021 amendments, we really started to see these various exemptions as becoming a functional capital stack component to private company capital formation. I'll pause there and see if you'd like me to expand in any direction.
So earlier, Robin, you were talking about that recently there was some guidance issued by the SEC that impacts both Reg CF and Reg A. Would you like to comment on that?
Yeah, absolutely. So on February 17th, the SEC put forth a series of compliance and disclosure interpretations. Those are publicly available on their website. And this is something that they periodically do to help issuers and other industry stakeholders navigate these exemptions compliantly. This is not a revision of the rules or certainly not statutory based reform, but it's just clarifying guidance. And they provided guidance on Feb 17th, as I mentioned, for both CF and Reg A. I could highlight one or two of each. Maybe that would be useful for context. So in the Reg CF context, so Reg crowdfunding context, um, these guidance, they're numbered. So if you care to look this up, it's number 100.06. This was confirmation that the annual income for investor limits refers to the calendar year and not a rolling 12-month period. So just to back up, what does that mean? Retail investors who invest in Reg crowdfunding offerings are subject to investment limits. They're not able to just invest an unlimited amount of capital the way an accredited investor is permitted to. And the formula for determining how much they're actually permitted to invest is something that's monitored and facilitated by the intermediary. So that's a funding portal or broker dealer through an investor investment limit calculator. This investor investment limit calculator is something that FINRA is really sensitive on. When you're filing to become a funding portal, you file a funding portal new member application, and FINRA is scrutinizing your calculator. They want to make sure that you're going to be helping investors really navigate these annual and what were considered annual investment limits. So there had been some confusion in the industry as to whether that annual investor limit refers to calendar year or whether it's a rolling 12-month year. And perhaps some of that confusion was because for an issuer who's raising up to $5 million, they're permitted to raise $5 million per 12-month period on a rolling basis. So if you're a private company and you want to use Reg crowdfunding, you can raise $5 million between February of 2026 and February of 2027. You don't have to evaluate that on a calendar year basis. But it turns out for the investor investment limits, we are looking at calendar year-based limits. They also clarified that rolling 12-month offering limit under 100.05. So that was another feature of the guidance that we received last week. Or now at this point, 2 years back. On the Reg A front, they focused on some simple points and some more complex. I think one that's very useful and perhaps something that companies aren't aware of when looking to file, it's called an offering statement on Form 1A. That's the big, robust disclosure document that an issuer submits to the SEC in order to begin the qualification process for the securities that they're intending to sell under that exemption. That filing can be made under DOS, D-O-S. It's a draft offering statement filing framework, and that preserves the confidentiality of that filing until the filing is moved out of DOS, out of confidentiality. So occasionally I'll talk to an issuer who's not aware that they can file on a confidential basis, and maybe they've even conducted a Reg A in the past, but the entire initial filing and then SEC comments process that follows was all public and could be scrutinized by competitors, for example, during that qualification process, which is typically a 2 or 3 month process. So now with this clarification under C&DI 182.24, it's been made crystal clear that any Reg A issuer can submit on a confidential basis for non-public staff review prior to registration effectiveness.
Okay. All right. So one quick question before we shift over to Europe. Do you anticipate any changes in the coming year from a regulatory legislative perspective within the U.S.?
Yeah, that's a great and really important question. I had been on the board of the Crowdfunding Professional Association for 2 years and on their policy subcommittee for 6 years. And they've done an amazing job putting together a pretty lengthy policy statement for really nuanced points that could help issuers and funding portals and other industry stakeholders navigate the crowdfunding rules more effectively, should those proposed changes come into law. And after quite a bit of outreach to Washington and visits with staffers, there was really only one point that made it beyond the House. It was originally presented under the Access Act and was then adopted into the framework of the Invest Act, which passed the House in December, is now with the Senate. And this relates to the reg crowdfunding reviewed financial threshold. So for very small issuers, they are not required to provide a review if they're raising around around $100,000 historically, and that's been proposed to increase to 250, with SEC flexibility to increase that to 400K over time. So I think this will be something that likely does pass and will be of import to small businesses and other issuers looking to conduct a micro offering under reg crowdfunding. I do want to just highlight a flaw that's sometimes not observed, and that's that even for these really small issuers who are exempt from having to provide a review, their financials are still required to be provided in GAAP. And that is something for certain types of small businesses that's just not amenable because they want to continue under a cash basis for accounting. So that's an area where I think if we could give relief from GAAP for these small issuers, we'd be in a better position. But any exemptive relief we can get is positive, especially for our small businesses. And the
Absolutely.
The Invest Act does contain a few other relevant provisions to Reg D. There's demo day clarification. And then probably most controversially, they've included further reform to the accredited investor definition to really expand the definition beyond just financial basis or holding certain series exams with FINRA to include a certification exam for knowledge to be able to be deemed accredited investors.
Yeah, so I think the accredited investor definition thing could be transformative depending on how it shakes out, but we won't know until Congress deals with that. So let's cross the Atlantic now, and we're going to jump over to Karsten. Again, Karsten, you're an OG. You've been doing this for years. I met you years ago at Cambridge, I think, for the first time. You've really been helpful to me as a source of information and perspective, not only what's going on in Germany, but Europe in general. So I've been very fortunate to have gotten to know you within the securities crowdfunding ecosystem. So let's start with ECSPR, European Crowdfunding Service Provider Regulation, which really was a cool thing that was supposed to be transformative, and it is transformative. There's just been some hurdles along the way, and maybe you can do a brief overview of ECSPR and what is happening now today.
Mm-hmm. Well, Andrew, thanks so much for having us here and hosting this webinar. I remember a couple of months, maybe no, it was probably weeks, but where we said we need to have more exchanges like these where we sort of learn from each other. And just from Robin's explanation about what's changing in the US environment is so helpful for me, because then I can go and talk to the European politicians about what the American crowdfunding exemption Reg CF is doing and how we need to adapt maybe. And so that's going to be a very helpful conversation going forward. And that's why I agree with you and Andy from GECA. We need to have these kind of discussions on what the different regimes have in common and also differences. So one of the things I think we have in common is that the politicians are realizing that there's a huge need for mobilizing private capital, especially also not just for startups and scale-ups, but also for infrastructure investment, investment into health, of course, the military, etc. So we have a huge need for private capital. And at the same time, we don't have often the digital means to get these leveraged and mobilized. So 10 years ago, when the ECSPR was first, the first drafts were being released and the discussions we had at the European Commission, at this point, it was a very fragmented framework. In some countries, it was not even possible to raise securities around online. There was no broker license available. In other countries, it was already more advanced. There were specific regimes, but still it was very difficult from one country to the other to have a cross-border business model where you could offer securities to investors in Spain, in Slovakia, in Germany, in France, and the UK at that time. So that's why the European Union and the European Commission especially said, we need the European crowdfunding service provider regime, the ECSPR, as a framework which harmonizes a lot of rules about how you license a platform, what kind of reporting you have to do as a platform, but also the limits and the scope of the crowdfunding. And right now for the ECSPR, we have essentially two types of so-called financial instruments which are available. One of them is transferable securities, so shares mostly, and then loans as a classic debt financial instrument. And we have many ECSPR platforms here in our call, which is great. So they should use webinar also to highlight what they do if they want later on through the chat. And anyway, so the limit for offering under the ECSPR is 5 million euros per year and per issuer. And the issuer has to, and this is across all platforms. So an issuer could use platform A and do 2.5 million there, and then use platform B and do another 2.5 million there. But in total, it has to be 5 million euros. There is no individual investor limit. Instead, we copied essentially an idea which came from the UK, and Bruce can maybe say more about this, is it's a flexible investor limit whereby the platforms have to understand the investor education and the knowledge which the investor has, and then put them either into the bucket of the sophisticated investors or the non-sophisticated investors. And for the non-sophisticated investors, they have to do certain tests to understand the knowledge. So it's a very flexible regime. The issuer, they have to release what is called a KISS. I really like this because sometimes the European Union tends to be a little bit very bureaucratic, but they called this KISS to make it very appealing. But of course, it's key investment information sheet, which is the disclosure document, 6 pages. And with that, an issuer can use a platform to attract investors all across the European Union and all member states if the platform has the license to do so. But most platforms have that. But we still see a fragmentation in the market. And I think it's partially due to regulation, and it's partially due to, I would say, investor appetite. And maybe that's something to be kept for the discussion later on. I don't know if, for instance, investors from Alabama like to invest into a startup from Alaska. I think Woody can say more about this because he has the data. But in Europe, like let's say a Spanish investor has a strong local bias to invest through a Spanish platform into a Spanish SME. And even though they could also go to a Slovakian platform and invest into a Slovakian SME or startup, we still see this very much in the data and also in the investor behavior, that this is, there's a reason why there's so many local platforms. And then secondly, of course, we have some regulatory issues. Some of the regulatory issues are related to that even though we have a harmonized regime, it's not completely harmonized in that sense. There's still some issues between some of the regulators do things slightly different than others, etc. So that's a problem. But on the other hand, I think this is being addressed right now. The European Commission is right now evaluating how things are going. And we have created this ECSPR working group, which is partially some platforms, associations, etc. And we have released last year an 80 pages report trying to assess what needs to be changed in the regulation, what needs to be changed in the practices of the supervisors, etc. But the biggest change, which I think we have all identified, and this is maybe sort of my closing on where we are right now, is the overall limit of 5 million euros. So as I mentioned, the limit is per issuer per year on all platforms. But there's a strange situation right now. If you are an SME or company trying to raise funds and you do it on your own website, you can do it up to 12 million euros without a prospectus. But the moment that you use a digital platform, you are limited by this 5 million threshold. And this is clearly against what the original intention was of the ECSPR when we first started talking about them 10 years ago, because the idea was really to provide capital to SMEs, to startups, to scale-ups. And of course, 5 million euros is very small. I mean, think about the investments needed for just starting an AI startup or whatever. So we have all advocated, together with our friends from the UK and all over Europe, to raise the threshold from 5 million to 12 million euros to make it easier for issuers to do that. And then the second thing, which we just discussed today in our working group, was functioning secondary markets. And this is probably, Andrew, what you meant with like technology is essentially taking over some of these functionalities, because we see a big potential in tokenization of digital assets, which can then lead to functioning secondary markets where you have enough liquidity to be able to influence also the raising of more funds, because then the SMEs, they see a functioning secondary market can provide also better exit options, etc. However, right now in the European Union, for instance, what we don't have a secondary market. It's not really possible. The platforms, they have to operate a bulletin board, which doesn't really allow the platform to match potential buyers and sellers of securities. And that's a big challenge which we have to solve together with the market. But
and Karsten,
yeah,
I have a quick question for you. You
Sure.
said that an issuer can raise up to 12 million euros on their own if they just put it on their own website. Is anybody doing that?
Well, I mean, we had, of course, I think, like all over the world, we had this whole topic of ICOs as well, and this fate quickly died. So, and then the European Commission, they wanted essentially to make it easier for issuers to raise securities on their own, but they are still then, they have to be compliant to certain laws, for instance, when they are addressing the public. So if they want to do it publicly in that sense, they still need to go through a platform. But if they do it as a private placement, where people are admitted only after they fulfill certain criteria, then they can do that. But our point of view is more that raising it through a digital platform actually is protective for the investors, because the platforms, they have to do due diligence, they have to do anti-money laundering check, they have to do the investor education and all of these things, which is not guaranteed if it's just being done, as a private placement, for instance. So that's why we would like to sort of harmonize these two frameworks. Yeah.
So, okay. So now you can raise up to 5 million euros within a year period, an issue, a small company. You are advocating to raise that to 12 million. So first question, why 12? Just because that matches what is already allowed. I mean, why not 20? Why not 50? And then is the commission acknowledging that changes need to be made? And are they going to improve the ecosystem for private securities marketplaces, including secondary marketplaces, for people to be able to sell and buy shares in private securities? Is that going to happen?
Yeah. Well, I don't know if it's gonna happen, to be sure. I mean, sometimes unexpected things happen, and or they might not happen. But in this case, the ECSPR, they have a specific article, Article 45, which says that this year they have to evaluate whether the crowdfunding regime works in Europe. And doing so means they have to also assess whether there are still existing obstacles. And a lot of us have raised this point that the 5 million threshold is an obstacle. However, of course, and this comes to the fact when it's going to happen, is then they have to renegotiate the whole text. However, what we try to actually try to say is we wanted to connect it to this 12 million threshold, because the 12 million threshold is part of what is called the EU Listing Act, which makes it easier for companies to publicly list securities on a registered exchange, so on stock exchange. And this is the above 12 million right now, you have to have a normal securities prospectus. So that's why we would like to connect it to that threshold. But sure enough, with inflation and the whole development in the market, I personally expect that the 12 million threshold is also going to be increased in the future. But for us right now, it would be already a big deal.
Okay. That's awesome. I have more questions for you, but I'm gonna have to ask them later, because now I want to go back to the UK and Bruce, who leads the UK CFA and is also, founder of Abundance. And Bruce is another OG. I met Bruce many years ago, once again at Cambridge. He's been just the leading voice for the entire ecosystem, which has been fortunate to have him on board. And in my opinion, the UK was the true pioneer for securities crowdfunding, because it really started there first. There used to be a bunch of platforms. Now there are fewer, but it's still pretty robust. And recently, there's been some changes in that marketplace. So Bruce, perhaps you can just kind of give a brief overview as to how securities crowdfunding works in the UK now. And then I want to shift over to, PISCES and POP and all these new developments that really appear to be an enhancement for online capital formation.
Yeah, sure. Thanks, Andrew. And yeah, good to see you again. So I think from the UK's perspective, a lot of the things we're talking about, they've sort of, there are various levels of borrowing that goes on between different markets and jurisdictions in terms of how crowdfunding gets put together. But the jigsaw puzzles are now starting to look a little bit different, I think it's fair to say. And it also is a function of what layers of rules and regulations you are sitting on. And I think that that's where some of the differences I can see, if you look over the arc of the last sort of 10 years, how things have diverged a bit, is because the underlying securities and markets legislation have all been slightly different in their start point, and crowdfunding, as a general rule, sits on top of those things. So for the UK, on the equities and bond side of it, so transferable securities, we've had a reasonably stable regime that over time has seen some changes until now, as you alluded to, Andrew. We've got these new platform rules coming in. They just came in actually in January and earlier on last year. But in essence, the platform is regulated to arrange deals and has additional permissions around that in order to promote those deals to the public. And as Karsten alluded to, we now have to segment those people according to their, I would say, sophistication stroke knowledge, but also their net worth in some cases, to say, well, is this an appropriate investment for them? So in principle, in that whole piece, the platform has a degree of responsibility and autonomy to decide that that is appropriate and the right thing to do. Alongside that, really by quirk of the fact that peer-to-peer lending was sort of invented from outside of regulation originally, we also have separate peer-to-peer rules, which operate slightly differently to the way they do in Europe, because we don't treat peer-to-peer loans as designated investments. They're not recognized investments. They are something unique. And actually, it's not the investment that's regulated, it's the activity. So we have a different set of regulations around peer-to-peer, and it does solve some of the issues around, for example, secondary markets, partly because the regulation had to mirror the existing practice that had already been established by people like Zopa and Funding Circle and the like. So where we are now is we've really, over the last sort of 7 years, I think, experienced a big shift in our regulation approach, moving away from what might be considered principles-based regulation to what would be called product regulation. And this is where I think we're seeing these dissonances and divergences, because when you get into product regulation, you start defining the business model of the underlying platform that sits on the rules. And where you're looking at business models, that's where you find it hard to cross borders. So whereas before we were sort of starting to move towards principles regulation, where you could build your business model and you had some responsibility for it, now 50% of the conversation with the supervisor will be about your business model, and you'll be talking about your business model. So that is where I think we've often seen the complication come into regulation. Now, the good news there is in the UK, we've started to see crowdfunding and also to an extent peer-to-peer be seen as part of a larger move for private capital mobilization, so private capital markets. And that is where, as you alluded to, PISCES and POP, public offer platform rules, have now come in. So for POP, we now have a separation between crowdfunding, where up to £5 million you can operate as a crowdfunding platform under the existing rules. Above 5 million, it is now unlimited crowdfunding. And that means we'll have much larger companies seeking to raise finance through those platforms, and more mature companies coming to the private markets, but issuing investments to the public. On the PISCES side, that is about addressing, initially, that was about addressing some liquidity issues in venture capital fund life cycles, but has now started to be opened up more to retail investors as well, although it's not completely. So that's where you can carry out secondary transactions in your shares with the public through with a restricted audience of the public through a PISCES transaction, and we're starting to see those come in now. So those are big steps. That means the crowdfunding is now joining up with listed markets much more, and the recognition there, coming on to Karsten's point about thresholds, the breakthrough there was that we proved with the work done by the Treasury in the UK that our threshold, which at that point was €8 million, was operating as a cap. So people were issuing up to €7.990 million equivalent in pounds rather consistently, and then not issuing just above that. And that was because above that cap, you picked up the requirement to issue a prospectus and have sign-off from the regulator, which was significantly more expensive. So that's where we are. So we've got a sort of more joined up system, but I would say we are still on the constraints side, particularly on secondary markets, as was talked about there. We also, in general, operate with bulletin board systems rather than a regulated market system, perhaps under, say, as an MTS. And we've pushed many times to have that changed on the basis that it would have better customer outcomes and it would help grow the market. But there seems to be some resistance to moving the perimeter that applies to regulated secondary transactions. The argument we always make is those rules are not built or made or even considered to be appropriate for crowdfunding. They're much too expensive and onerous for crowdfunding platforms, and they would preclude smaller transactions occurring on those markets. And then on the marketing side, I think what we're seeing is an increase in the what are called frictions in the customer journeys as a general rule, and that has led to smaller amounts of marketing being done by platforms, lower levels of marketing, because the cost of marketing has gone up enormously if you have a greater drop-off rate in your customer conversion. So that's a good example of where the regulator has really got into the weeds of a business model without necessarily understanding the implications of that, I think. And we have been pushing now for the last 2 years to get a review of those rules. We've just managed to do that in a discussion paper that was issued in December. So that review will look at whether these frictions have gone too far and are disproportionate. And then on the third one, just picking up on the tokenization point, I suppose the UK's approach to tokenization has been to weld it into the existing infrastructure of crowdfunding, I would say. How well that weld will hold, we'll see. But essentially, if you're tokenizing an investment asset, then you are treated as operating regulated activity in the same way. The tokenization does not exempt you in any way. So really, tokenization then becomes about the efficiency of the technology and the effectiveness of the platform, rather than opening up new regulatory forms of crowdfunding, if you like. It's been seen as a technological adjunct rather than a breakthrough innovation in the way that, say, the invention of peer-to-peer loans was back in the day.
Are you bullish about, POPs, PISCES, and tokenization going forward? Granted, it's the whole evolving private securities market is it's really early in these PISCES and POP. But how do you feel about that? How do you perceive that?
Well, I think, yes, it will come down to the platforms and their ability to invest in creating these platforms. So I think the effort to get the rules built was a 5-year effort. And now Crowdcube, in particular in the UK, has led the way on that. It is working closely with the London Stock Exchange. So that gives you some idea of crowdfunding sort of coming into the mainstream. So I think it's really about now how the platforms take advantage of the structure that is available. So I feel bullish in the sense that I think there's a latent demand. Where I'm cautious is that we're still being treated as if people can't make decisions for themselves when it comes to investing. So we've got this mixed message in the UK, and I don't know if that's elsewhere, where the government is desperate to encourage people to just, we're saving, i.e. putting money in deposits in banks far too much, and we're not investing enough. But they're not willing to look at one of the areas where they could unlock. In the UK, it's probably 100 billion if they were to look at the marketing rules again. And it's just somewhat an area that's just not well understood, both at a policy level, but also in terms of the consequences at a regulatory level. But we're working hard to change that awareness.
You could help me out here, because in the United States, you have certain percentages of what you can invest as a non-accredited investor. An accredited investor, as it stands today, is someone who has a net worth of over $1 million, not counting their primary residence, or they earn over $200,000 a year, $300,000 if you're married. It's pretty straightforward. It's been the rule book for decades, since the 80s. There is a movement to change that and to create the sophistication qualification, which I support, and I think it'll be a good thing. In the UK, it's a little bit different, though, because you have high net worths, you have sophisticated investors, and then you can have everybody else. Can you explain that, for me, so I can better understand it?
In very simple terms, we don't assume if you're wealthy, you know how to invest, or that you're clever. So we just assume you're rich. So yes, rich people can lose money. They have their own segment called high net worth. They're looking at changing the boundaries there. They keep looking at that. Sophisticated investors, they self-certify, and they have to prove that they've done certain things, or they've been directors of companies, or made investments similarly in the past. And the third is restricted investor. That's our catch-all for everybody else. If they can pass a test, which we call an appropriateness test, then you can invest as a restricted investor, which is that you are saying you will not invest more than 10% of your net investable assets. So those are the three groups that we have. So there are no other groups, because if you fail that test, you're barred from investing on that particular platform. And again, we're looking at how that test is currently working, and we think at the moment you probably have to getting 100% pass mark. You aren't even required to do that if you want to be an airline pilot. But if you want to make an investment, then you have to get 100%, I'm afraid. So otherwise you've failed, and we can't tell you on what you failed either, or help you think about or learn from your mistakes. So again, we're saying that sort of black and white approach seems to be overly risk averse in the UK, but it is a big driver of the cost of marketing at the moment in the UK if you want to promote an investment.
There's something else I want to ask you about, which is unique to the UK, are your what we call tax exemptions, the EIS and the SEIS programs, which from what I can see has been beneficial for investment crowdfunding platforms. And what is your opinion on these programs? How do you see that developing? Are there any changes in the works? And can you explain it to the rest of the audience? Because really the UK is the only place to build it.
Yeah, so for people that are taking a risk, investing into startup and growth companies, we have two schemes. One is called CEDIS, for seed companies, and then we have EIS, Enterprise Investment Scheme, for larger companies with certain limits on size and length of investment that go with that. And for that, the investor receives a tax relief of 30% or higher for the CEDIS, 50%. And then there are certain loss reliefs also that can be applied. For investing into things like peer-to-peer loans and debt products where you don't get that loss relief, we have the Innovative Finance ISA, which is an extension of a tax-free saving and investment structure that we have in the UK that covers everything from saving up to buy a house, having your savings in cash, putting your money in the stock market. Well, the Innovative Finance ISA covers all the things that don't fit those descriptions. It's also, you can now actually also invest into exchange traded notes in crypto through the Innovative Finance ISA. So it is there, your returns, as long as they're within that wrapper, you can subscribe up to £20,000 per year into that, and so build up quite a large pot over a number of years. And all returns within it are free from any tax on the capital gain, and income that you get from that pot is also tax-free. So there are major drivers of investment.
Okay, so you're supportive, and this is working out well in the UK.
I think it's the one thing we've got right, and we will always we will defend ISIS until we die.
Okay,
It's
all right, well,
it's
that's good.
it's a key driver of growth, because in lots of other ways we're at a disadvantage. You know, in the UK, when we're investing our money, this is a cultural thing. We don't like to pay tax on the returns. And so for crowdfunding to compete in that space, you've really got to give it the same sort of protections that you have if you want to invest in the stock market or through your pension. Otherwise, people wouldn't use that. More wealthy, more sophisticated, high net worth investors would not use that. And of course, whilst we encourage a volume and a more democratic investing culture, we also follow the 80-20 rule when it comes to the amount of value that you acquire from each individual investor.
Okay, all right, that's helpful, and I'm glad you got something right. Karsten, you understand EIS and SEIS. Is this something you're reviewing with European Commission officials about looking for a way to mitigate taxes and reduce risk for private securities investments in the Europe?
Yeah, so on the European level, there wasn't so much a movement about taxation or providing tax incentives to investors, because taxation in the European Union is still a national competence in that sense. So the European Union doesn't really want to say anything about taxation. This was the past. So what they did, they provided guarantees, like loss guarantees. So some platforms have worked with the European Union funds and provided a first loss guarantee, especially on loans, but some on shares as well. However, now I think it's picking up, to be honest, because as I mentioned earlier, we see from the UK how influential this can be in order to motivate investors to use this. And I also think it's not just about, promoting maybe crowdfunding through the platforms, but it's bringing retail investors closer to become angel investors over the long run. So the tax incentives are not so much just for, leveraging more capital, but it's really just about opening up these type of assets to a new group of people, and like tax incentives would really help. So I do talk quite often with people also from the European Council on this, and there's a whole debate right now about trying to come up with a harmonized framework for tax incentives through digital platforms, especially the French and the German government. They just released, for instance, a joint report which all talks about how to raise more private capital. And but unfortunately, right now, let's come back to the 5 million threshold. The total crowdfunding market is, of course, in Europe much too small compared to other capital markets in Europe. But people are seeing this as a way of getting the idea of a integrated capital market union closer to reality. And this is why I'm very positive on that. But I don't know if we're going to, in the end, we'll copy the UK in terms of the EIS scheme, because that's going to be a big challenge. But we will see. We will see.
I would love to see the USA copy the UK with these tax exemptions, SEIS and EIS.
For sure.
In general, it's a subsidy in effect, but in general, I don't support subsidies. But I think if you subsidize anything, it's entrepreneurship, it's innovation, and it's opportunity.
For sure.
And you want that happening in private markets, at least in my opinion.
I think also you could get those. So EIS and what we called VCT, venture capital trusts, had various tax breaks already. So people were in collective schemes. However, those schemes had a minimum investment level, often sometimes even £500,000. So they weren't very democratic. So if we were going to increase the amount of money going into these high risk companies, then those investors needed to be doing it on the same risk and mitigation terms that you have with the EIS and VCT funds. So it's really about level playing field for the UK. That's how we argued it. And I think, so it really depends on what sort of tax breaks your current venture capital industry has, and saying, look, why don't individual investors get something equivalent for them? Because they are taking the risk. They're building companies. They're doing something useful with their money. They're not just sitting there passively hoping for the stock market to go up or down, at an index tracker. So these are the people that are taking real risk, if you like. And you can also measure the benefit in terms of those companies that get created. And then the tax question, it becomes very good value for money from a tax subsidy perspective, because it's fundamentally going into the economy. You are not subsidizing secondary trading of very old companies.
I agree. And it's difficult to estimate the multiplier effect of supporting innovative young firms and the job creation, the overall wealth creation. And I think it gets lost in the discussion because it can be intangible. Of course, you can estimate it and say, we're doing this and this and that. But I think people miss the point. Regulators and policymakers miss the point about the opportunity that exists and the benefits it generates for any economy. So on that note, I'm going to get off my soapbox here and pass it all back to Andy, who's been waiting for me to finish. And I want to thank, Karsten and Bruce and Robin, who had to sign off, for sharing your insight and your information and your expertise to our audience. It's really awesome, and I appreciate you being here.
Thanks, man. Thanks.
Thank you, Andrew. Yeah, that was truly enlightening, and I think those roundups, we could have a separate webinar on each of those jurisdictions, just to go through what's currently happening at the moment and what we see happening in the future. And there are other areas of the globe as well that we haven't got represented here that we can do similar to as well. So we'll do that in the future. Thank you so much. We're just going to move straight on now to our roundtable discussion. So Karsten and Andrew Dix are going to actually form part of the panel on this one as well. But I'd like to welcome 4 other participants to this discussion as well. So we've got Konstantin Boyko, who's CEO of LenderKit. LenderKit build tech that empowers crowdfunding systems worldwide. He's also CEO of CrowdSpace, which connects platform investors and fundraisers together through data. We've got Neera Patel, who's Chief Product Officer at Dacxi. Neera's got 20 plus years of expertise in driving 0 to 1 digital transformations and launching high impact products in fintech and payments. We've got Sherwood Neiss, or Woody, as he's known as. Sherwood is a co-author of the US crowdfunding exemption framework, Title 3 of the Jobs Act, which legalized investment crowdfunding in the US. He's also co-founder of Crowdfund Capital Advisors, where he leads research and data initiatives, tracking thousands of private market offerings globally. And last but by no means least, we've got Benoit Collas. Ben, it's great to have you here. Ben oversees international growth at EU platform Enerfip. His goal is to connect impact-driven investors with high-impact projects, ensuring the financial sustainability of green initiatives. Thank you all for being here. I'm sure we're going to have a great discussion here. We're going to start off actually just as a follow-on to what we've just been discussing on compliance frameworks, and a bit of an open question to the group. Although I'm particularly interested to hear from sort of both sides of the pond, maybe from Ben and from Woody. Do you see compliance with regulation today as a bridge that enables growth or a wall that blocks it? So I'd be interested to hear your views on that one.
I'm more than happy to jump on in. And by the way, thank you for having me. It's exciting to be here, particularly on a global level, because it's fascinating to hear how we all do things, the same thing differently. So it's this is a great conversation to see how we can actually come together to do something even better. When it comes to is regulation a block or a bridge, I think it's sort of both. You need regulation there because it helps provide clarity. But when it's not uniform, it can be a block. And so, and we're going to talk about this later on, we've got sort of clarity within the online investment space in the different tiers that we talked about as to how you can raise money, which works. But then when it comes to secondary trading, it's governed at the state level. And so we've got different jurisdictions. And so it becomes a block. The other thing that I think works with this, that at the federal level, where we've got these covered securities and why it's a bridge, is when you've got a disclosure regime that is sort of standardized, it builds a level of trust. And so people will become familiar with the standard. They know what to look for, and you build trust in the system. And so I think it works in that way to help bridge these transactions and take people who don't know each other, companies that might not know these investors, and actually introduce them to these opportunities. And I think that's a lot of what even Andrew was trying to get at with some of the acts that we have in front of Congress right now that can help improve this here in the United States. So, I mean, just as a get-go, I think that's how I see it.
Yeah, it makes perfect sense. What about you, Ben, from an EU perspective?
Let's say that we're a huge company. If we compare with other platforms, we're 70 employees. So let's say that we have internally a compliance officer and so on. So it's fine. She's managing all this and it's perfect. But if I were a small platform, like let's say I was only beginning, for me, it would be a nightmare to see so many obligations that I won't understand anything. So let's say beginning, it's hard, too much compliance, but after a while, it's fine. And it's very important, as you said just before, what it's supporting, put a trust and to say, okay, this is a kind of licensed product and it's always the same and so on. So I can rely on it.
So when it does look good and you've got good compliance and it's acting more as a bridge, what does that compliance actually look like in practice? How can platforms turn it into a competitive advantage rather than just a cost center, an expense? Anybody got any ideas on that in particular?
I mean, there's, it's a loaded question. Only because, and the reason I say it's a loaded question is I don't want to throw platforms under the bus. Compliance is, laws are written for a reason. In the United States, one of the things that we have written in there is you have to file annual reports. You have to file it with the SEC into EDGAR, which is the disclosure regime. It has to be made available to investors. It's got to be put on your website. And it's in there for a reason. Like you take investors, you owe them a fiduciary responsibility to tell them what's going on with that money. Compliance with these annual reports is abysmal here in the United States. And I think it comes down to what we were talking about just earlier, which is it's a little confusing. Filing into EDGAR is not the easiest thing. Understanding what the regulations are or your responsibilities for those ongoing disclosures can be confusing. There's no clear guidance from the SEC as to what you should be doing with it. And so a lot of people are thinking, well, I either go down this path with a law firm, which can be very costly, or I just try and do it on my own, which I could make mistakes. But the platforms themselves, I think, should be providing the guidance that can help with this, because it behooves them to actually get this ongoing information, these annual reports, in the hands of all these investors, because from my point of view, that just builds, again, trust. So if you have the platforms incentivized to actually assist these issuers with their ongoing disclosure requirements, then in fact, investors will have more access to information. By the way, access to that data itself is great for people like me that do a ton of analysis on the entire industry here in the United States, because it just gives me more data to say why we should increase the caps, why we should have tax incentives for this. Without that data, it makes it harder to have these arguments. But the platforms themselves, I think there's a way in which we could create mechanisms for them to, get this information in the hands of the issuers so that they can do their compliance requirements.
Yeah, that makes sense. And do you think, Karsten, probably one for you, do you think that a similar kind of process implemented by platforms would be suitable for Europe, for the obligations of the founders for European businesses looking to raise capital?
Yeah, I mean, I think one of the reasons why the platforms were asking for the European regulation intention was to reduce the cost of having to find out how these business models fit into regulations which were not done for them, right? So the crowdfunding service provider regime in the European Union is actually quite helpful, because it reduces uncertainty for the platforms. And so what we find quite often now when we are talking about the implementation and how we have to adapt those rules, it's often that we go to our European regulator, ESMA, and tell them, this is where we actually need clarification. And one of these issues is for sure related to disclosure. So for instance, we have this 6-page key investment information sheet. And the issue there is that sometimes you have to fit a lot of information to it. So that's how we go to our regulator in order to clarify, what is the exact amount of information that needs to be put in there. And so, but I think in the European system is a little bit different from the US system in the sense that people can or tend only to do things which they're explicitly allowed to, other than saying, okay, no, we just do it and see if the SEC, is going to put us in jail, etc. So that's why it's a little bit, it takes a bit longer to get this kind of clarity that you were referring to.
Yeah, I'd like to jump in here because Barry just mentioned this and he was reading my mind. Is we should bring AI into the conversation, because it is my personal opinion that tokenization and compliance, along with artificial intelligence, can be cooked into the entire process to streamline things. And while we may not get where it's fully automated in a year or two, I think that's where the trajectory is going, where we can satisfy the regulatory demands of the regulators, as well as, provide the information to the platforms and the investors that they deem is valid. I will note that the current Securities Exchange Commission leadership is pursuing an update to the disclosure requirements, which have become so cumbersome that, it's written by lawyers for lawyers, and nobody in the right mind reads it except other lawyers who are looking to sue somebody. I mean, it's really nonsensical, but to try and provide valid information that satisfies what an investor is looking for, and to satisfy all the demands from a compliance fashion. So I think that needs to be part of the conversation for each individual jurisdiction. And I also think going forward that you're going to be able to see a process where that can also enable cross-border securities offerings, where an issuer can say, I'd like to raise money, within the 50 United States, but I kind of like the UK too. There's some VCs there that I wouldn't mind having, participation from, and I can automate much of all of that process. Now, maybe you think I'm Pollyannish, but I think that's where we're heading.
Andrew, it's kind of like you're reading my mind, because that segues perfectly into kind of the next section, which I want to talk about, which is emerging technologies and tokenization. Obviously, AI being one of those. Because you're right, we're talking about here on a regional basis, but obviously the implementation of such technology should actually be able to at least assist in part in the whole issue around the cross-border collaboration piece. So, Konstantin, I'd like to come to you if that's okay, and I'd just like to know from your perspective: is tech something? I think I know the answer to this one, but is tech something that you feel will help solve the fragmentation issue, or could it risk making it even more complex?
Well, the technology definitely can make things complex, especially if it's not done right. But the real issue is not really the technology. The technology is there already. The issue starts when you try to connect the technology to real life and real processes. So, for example, if we look at it from building the platform perspective, it's not so difficult to build the whole technology for the platform, but until you connect the technology to real things, it's still a virtual layer. So it's something you can use, you can operate, but then you have to think about how you move money, how you connect it to the payment provider, how you do KYC onboarding, and then different reporting. And here where the problem actually starts. One of the issues which we see among our customers and people we talk to is how do you choose a payment provider? And if it is difficult, even if you operate in one jurisdiction in one country, or even within European Union, even with harmonized regulation and so forth. But what do you do if you want to operate in different jurisdictions? Do you need two payment providers, or do you need one which covers different countries? It is not easy to solve. So technologically, and actually I want to jump to previous comment of Andrew for AI. I think AI can greatly improve a lot of compliance procedures actually and simplify them, because you don't have to write manually all those documents like key information sheet or any other things which need to be written. And I'm sure now a lot of lawyers spend a lot of time writing those, and they write them in very different ways. Everyone has their own style and way of doing it. But if it is standardized and good number of those documents can be standardized, I think it could reduce costs quite good.
Which is obviously going to be music to the ears of people like Ben, who has the platform. Obviously, costs will be an issue and something that have to be considered. And anything where technology can reduce costs, but help you stay compliant, can only be a good thing, right?
Yeah, sure. But feel free to comment.
Yeah. That was aimed at
question
you,
for
Ben.
me?
Yeah. That was for you.
No, let's say I would like to say yes, I'm in favor of intelligence, artificial intelligence, but so far we haven't done the first move yet. So let's say that it's for tomorrow. So of course we all know that it's coming. We're working on it, but it's so far it's only like from each one individual perspective, and not used at the employee at the company level. But of course we must work hard, because of course as the keys information for in our perspective, we used to translate it in several languages. So it's not a big move to switch to AI to translate, but of course it's super helpful. But still, it's need to be done with human every time we do something with intelligence artificial. Sorry for the bad spelling. We used to make it check by someone locally. Otherwise, it's a mistake. It's not enough so far. So it's a mix of two.
Sure. And trusting in the technology is something that still needs to be gained, I suppose. So Neera, have you got an opinion on how shared infrastructure or networks can make collaboration easier between platforms? I mean, at GECA, we are constantly talking about how the industry needs to actually come together and collaborate in order to compete with other investment classes. Is this something you have a view on? And also, I'd be interested to hear your views on the AI piece, and how that can affect the trust.
Yeah, the AI conversation is a great conversation. I think, yes, a coordinated global ecosystem, which replaces the fragmented sort of national markets, is fundamentally enabled through that shared infrastructure, network connectivity, and that essentially that connective tissue that we're looking for. And technology is critical to that. So, the first is enabling that scale, cross-border efficiency, where you have potentially a neutral infrastructure that facilitates that deal sharing, the sharing between the platforms, and enabling that effective cross-border transactions. But, moving into sort of the space where we've just been talking about, which is the AI, yes, this drives operational efficiency. Issuers can raise a deal on, say, the network or a network and apply automated compliance checks, leveraging AI and, specialized AI, maybe something to do with compliance, and there could be other AI agents doing other things. And as Ben rightly said, you could also have someone, a human element as part of that journey. And that's something that we've been looking at here at Dacxi already. So, you can actually move the deal through that compliance check much faster, have it negotiate and look through multiple jurisdictions in partnerships with other platforms. So there could be some flexibility involved, and essentially reducing that burden of duplicative manual legal reviews, which essentially reduces your costs and increases your speed to market, which is everything, all these platforms want. So I think, that's where I think AI can definitely come in, and it can be very flexible, depends on how you design it. I think additionally as well, you can also, that collaboration of shared infrastructure side of things can also play a part in improving the investor experience. I mean, previously on other GECA calls, I've mentioned about integrating unified KYC. This is a point that comes up more and more when I speak to platforms all the time, is that, a shared infrastructure that streamlines the unified KYC, which therefore allows investors to skip that KYC process or minimize it because you're using verified credentials. Essentially, that improves their investor journey and significantly reduces the investor drop-off rates. And overall, could potentially reduce your KYC costs as well. So, that's where shared infrastructure, I think, can definitely come back in.
Yeah. So using the technology to streamline processes kind of makes sense. And Andrew, we're looking more at emerging technologies, and you mentioned earlier that tokenization is increasingly becoming part of the conversation, not just as a buzzword, but as potential market infrastructure. So how do you see tokenization practically impacting crowdfunding and sort of further on down the line, cross-border investment in the near term? Oh, you're on mute, Andrew, just at the moment.
Thank you. You already see it in use on multiple platforms. Republic was early in offering digital assets and tokenized securities. You have Securities, which started as an enabler and kind of morphed into a platform as well. Now it's a publicly traded company. You have companies like Figure, which started really from the institutional side. And so you see these outcroppings, these innovators that have pushed forward to develop the technology, to learn from it, and then continue to build upon that. And inevitably, that's going to filter down to some smaller securities offerings, because it just makes a lot of sense. Now, we use a lot of buzzy terms and we try to make it look really sexy, but tokenized securities are still securities. And there are other digital assets which may or may not be securities, but in the end, it's about removing intrinsic friction and reducing costs and improving security and improving portability and compliance. And today in the analog securities market, so much of this stuff is done, with a real person, guiding it along its paper path. We can remove all that, and that can improve everything for everybody. At the same time, you can also foster a new generation of assets which will be made available to investors. So are we there yet? No, but you can see where it's going, and you can see what's going to happen. And I think that the institutional side will probably, in effect, lead the way, but you do already have platforms that are focusing on early stage, and Republic, which is already doing it, that are kind of leading the charge, which will help evolve the change. The Clarity Act, which is the market infrastructure legislation, really doesn't address digital securities that much. It's more about digital commodities. We don't need to discuss that right now, but it is part of that equation. It's part of pushing this all forward. It's part of improving access to capital, improving investment opportunities, and improving an investor experience. And tokenization, the digitization of finance is going to play an enormous role in all of this for everybody.
Yeah, so we're seeing it from that perspective. It's very realistic to say that it will play a major part in everyday capital raising. Konstantin, is that something you would agree with, in terms of this is somebody who builds platforms, right?
Yeah, well, there is definitely demand for tokenization, but again, tokenization is just a tool for which connects digital world to real world. And if we talk about cross-border things or collaboration between platforms, I still think that the challenge which needs to be solved is how to make it all compliant and legal and really connected to how things should be operated in those countries. Not really about technology. Technology is kind of ahead of things. Now the question is how to make it compliant.
Yeah, exactly. And I suppose the technology is there that can enable the cross-border operations, but regulations got to align with that in order to have a working machine. Ben, I know this is something you've experienced fairly recently in terms of a cross-border deal. Do you see platforms as a platform yourself? Do you see other platforms as partners or competitors? Could you sort of enlighten us a little as to what happened with the deal recently that you've been involved with in a cross-border deal?
To answer your question, let's say that in energy transition, we're quite cooperative. So let's say that we really work together, which is good.
Yeah.
In crowdfunding, it depends. If you remain in France, we are still competitors. If you go outside, it's okay. We can work together.
Right. Okay. So expanding outside of the borders of your own country sort of adds the scale, whereas there's still the competitive element if you're talking about potentially sharing with platforms within France.
They see campaigns, they buy them.
Yeah. And it's just that, you're the newcomer, so everyone welcome you. And then maybe after a while, we won't be friends anymore. Just to
yeah, sure. Sorry,
some experiences that we had. So we did some, we call it sharing deals in the past. But we don't have that much example. Let's say that we did one with a neighbor country. And it was again possible only because even with the common framework ECSPR, this country, this platform had a special layout and was able to do an investment in one of our projects with a separate vehicle, which is most of the time not easy. So once again, if compliance says yes, it's fine. If not, it's much more complicated. So we had this nice example, and then we wanted to reproduce it, and then not a single platform could support it because regulators said, no, you're not allowed to invest that way. So it's over. The game is over.
Right.
So yes,
Yeah.
we had some example, but not that many. And today we try again. But it's not that good. Maybe tokenization is a way we can study, but we are not advanced.
Yeah, sure. And those
So-
issues were from one ECSPR regulated entity to another, which is interesting. Karsten, did you want to say something? I saw you had your hand up.
So really briefly, I think there are 3 challenges where tokenization can actually help this kind of the solution. So one of them is usually one platform, they do the due diligence on the project, and they should receive a higher fee on this investment round because they carry the workload in sharing this project, this campaign with other platforms. So this is where tokenization can play a big role because you essentially can assign the fee and have like a finder's fee, etc. Then the second thing is platforms don't like to share investor data with each other because, investments is like a holy grail. You want to keep your investor base. You don't want to give other platforms the names and email addresses of your investors. So in this case, also tokenization can help because the platforms have to comply with the fact that, there has to be certain limits, etc., from the investor side. And but essentially you can use tokenization to ensure that the regulation has compliance with, but you don't share personal data. And the last thing is where tokenization, I think, is also quite interesting is when it comes to reporting the outcomes of equity crowdfunding. So when you want to ensure that every investor has the same access to information about what is happening with the project on the ground, because then you can use a decentralized infrastructure which can nevertheless distribute information to everyone equally without having to have one central gatekeeper who's distributing this kind of information. Everybody will have their assets on the blockchain, and by doing so, each platform can ensure that this. So this is, I think, the quick benefit. But what I think we, as a humanity, we have the challenge that most of the renewable energy investments, we need to be in Latin America, they need to be in Africa, they need to be in certain parts of Asia, but the capital is in the north. So I think what I want to see is where we raise capital jointly together across the globe to make sure, that we have renewable energy infrastructure in those countries where they make sense from an engineering point of view. And this is actually the challenge which Benoit and Enerfip is also trying to solve.
Yeah, a very important point, actually. Thank you. So Neera, just last little word on this subject. From everything that we've just talked about in terms of the emerging technologies, presumably you would be in agreement that realistically we could see cross-border deal sharing or syndication, and we think that is on the horizon, however far down the roadmap.
Yeah, no, I definitely think so. And, I've been talking to a lot of platforms. All of them want to do cross-border deal syndication. And, there is a very realistic view that, the economic imperative is to really close that gap, that there's a massive financial gap around and SMEs to really try and fund that gap, and cross-border deals is the way forward. There's a lot of academic research that basically also alludes to this as well. But I think essentially, I think the combination of technology, regulation, they do need to work with technology providers such as ourselves and many others to really start to understand how technology can really help power the ecosystem forward. Karsten's just mentioned about, sort of tokenization, but I think it's wider than that. When it comes to blockchain infrastructure allows that mutability. It allows the idea of sharing platforms to be able to see the deal tracking, which, they're finding very difficult on off-chain solutions today when they are deal sharing. And so this is a really important aspect of what blockchain can do. Because of that immutability, they can trace the deal performance, they can check payments, disputes, withdrawals. All of this is very important for sort of the compliance burden that many of our platforms face. So I think, crowdfunding as a cross-border deals sharing area is really important. There are barriers. There's tax. I mean, Ben's alluded to tax. There's also the business models as well. So for syndication to really scale, I think the industry needs to solve how the fee split friction is going to kind of come about. They need to discuss how that works. Maybe that's through standards. And maybe that's through GECA partnerships with you guys on the GECA forums, is to see how can we overcome a lot of these barriers so that we can collaborate, solve these issues, and then bring through technology through AI, whether it's the use of AI, smart contracts, etc., so that we can actually enable very successful cross-border deal sharing.
Fantastic. Thank you, Neera. Look, I am running a little over time, so I apologize for everybody. I hope we're not keeping you up too late, but I just wanted to touch on one other subject, which is secondary markets. It's really, really important part of the ecosystem. And as the ecosystem is maturing, attention is naturally shifting away from primary issues to what happens after the raise. And with that in mind, it's clear that a good functioning secondary market is absolutely critical to the long-term sustainability, credibility, and scalability of equity crowdfunding. So, Woody, I know you've got some views on this. In the US context, what are the structural or regulatory barriers that prevent secondary markets from scaling? And is there realistic momentum to address those?
I mean, I agree with you. I think secondary markets is like the next frontier, as well as this international collaboration on, the primary issuance. The issue that we have in the United States is the primary issuance of securities in the crowdfunding realm is regulated at the federal level. When it comes to secondary trading of the securities, you would think if it was, covered at the federal level when the primary issuance, therefore, if you want to trade it in the secondary trading, it's governed by federal, at the federal level as well. That is not true. It is actually secondary trading is governed at the state level. And so what does that mean? It's sort of this whole conversation that we're having right now. You've got 50 states with 50 different jurisdictions and 50 different rules when it comes to what those state securities administrators want when it comes to disclosures for investors for secondary trading. Now, we've tried to tackle that a bit in the United States by coming up with what's known as the manual exemption. And the states saw this as an issue early on. And so they 43 states came together and they said, if you publish a standardized list of information into what's known as the National Securities Manual, and I put air quotes up there because it's it used to be an actual book, and now it's actually an online form. But what it is it's the next thing to Edgar. It's like Edgar Light. But what it says is you're putting this information in there, you're verifying, you're saying that it's actually truthful, so we can hold you accountable for anything that is off of, the truth. But what it does is it allows issuers then to publish information into the manual and then allow for trading on these alternative trading systems, these public exchanges, the really quasi-private exchanges, that will allow for the secondary trading. But, it's sticky. It's confusing when it comes to what they call blue sky laws, which is, how we do the secondary trading. It's confusing and people just don't understand it. And I think it's been a deterrent to secondary trading activity picking up in the United States. What we've seen, and this goes back to what Robin was talking about early on, is when she was talking about Reg A plus issuers actually having the ability to trade their securities once it's qualified by the SEC, that's where we're seeing most of the traction taking place. Why? Well, those are bigger issuers. They've got, companies that are doing much larger things than these smaller regulation crowdfunding issuers. And so there's a lot more demand. And I constantly bring this up, which is it'd be great to have secondary trading. We definitely want to work through the issues related to it. A standardized disclosure regime on a global scale will be beneficial to that. But it will come down to supply and demand. You can have all this supply for secondary trading of these securities, of these companies that have these, liquid assets now, but unless they are outperforming such that there are investors that want to buy those securities, you're going to have a very thin marketplace.
Yeah,
that
I'd
makes
like
sense.
to
Sure, Andrew,
jump
yeah.
in there just for a second. First of all, I agree with Woody and what he just explained. The state ecosystem is a mess. It's a Byzantine mess. And the states don't care because they just want to keep their empires going forward, even though it makes a lot of sense to have a federal ecosystem for secondary trading for many of these securities. That being said, for the Reg D market, there actually has been multiple platforms that have emerged to enable trading in the Reg D market, like NASDAQ has a private market. You have Forge, you have equities that were purchased by Morgan Stanley, as there is a lot of interest and demand in this market. And the SEC is also knowledgeable on this, and they understand that it's part of the equation. In fact, there was a meeting today at the SEC about private markets, and while I didn't watch it, I'm assuming that part of it was secondary transactions. I think that as you stated, Andy and others, that creating a liquidity opportunity beyond an M&A event is absolutely vital. I think that the blockchain, AI, tokenization ecosystem will be a big part of that equation. I'm assuming, Neera, that that's some of the things you're working on. But I think it can satisfy both sides, the investor, issuer, and the regulator. I think that can all be baked in. And you're already seeing in the United States where the New York Stock Exchange announced that they're launching a tokenized securities exchange. It's gonna happen. It is happening. And it's a good thing. It's just like, embracing it, supporting it, and going after it, and not being a roadblock to it.
Yeah, thank you, Andrew. Look, I just want to squeeze 2 more minutes in just to get a view from the UK. I'm sorry, Bruce, to bring you in. I know technically you aren't part of this, but just to see if you echo those sentiments. But also from Karsten as well from the EU. That would be great, and it would be a fantastic way to finish the conversation today.
I think on secondary market, I think it's how you frame the conversation. So I think the worry here is that there will be some sort of less, lower regulated alternative to the full listing protections and the full listing scrutiny, but also the full listing costs. Let's be honest there. And I think that there's definitely a realization there are a number of companies that are, growing outside of that conventional infrastructure of the public listed route, and who would benefit from having some liquidity. But then it's about what sort of liquidity are you offering? And I think that PISCES is an example there, because you're talking about the ability to offer a liquidity event to refresh your shareholder base, to bring new investors into your private company at different points, because not everyone wants to follow your whole journey. And I think that's the bit that perhaps needs more education for regulators, is to understand the life cycle of companies now and what the realities are of that, and what are the benefits to investors, but also when do investors want to exit. And I think that's the key moment, because if we can create that ability to provide different sorts of liquidity, you will move more capital and recycle more capital into your economy. That's part of the problem here. There's a lot of capital tied up in companies waiting to go to IPO. I mean, Zopa is still waiting.
Yeah, well, better liquidity means better investor confidence and more capital for SMEs. It's kind of what we're all about. Yeah. Karsten, do you have a very quick view from the EU?
So in Europe, we have a lot of different stock exchanges, and they are the fiercest lobbyists against anything which could threaten this sort of monopoly. Even the French and German government, they were trying to say, hey, do we need to have all of these exchanges in every country? Shouldn't we have, like a European exchange, for instance, for scale-ups, AI companies, deep tech, quantum, where they can seek funds quite easily and do their IPOs there. And it's unfortunately an issue to protect their turf. And this is also the reason why we have this regulation in the ECSPR right now, because people were thinking this could be regulatory arbitrage for anyone who wants to open up an exchange, and they just simply register as a crowdfunding platform and then have a secondary market. But this is, in my view, as Andrew Dick said, this and Woody has said, this is going to be the next frontier for us, because we see that that often retail investors, they they tend to diversify their portfolio in a way that their risk appetite, of course, matches, what they invest in. But if there is no secondary market, then no exits are possible because the VCs are still, the exits through VCs are still too small in most countries in the European Union. And therefore, this would be my hope that we somehow, and maybe I'm going to take up Neera's point here, maybe through GECA, we need to come up with a standard which would allow people who, regardless whether they have listed first on an American platform, Canadian, UK, or European one, to be able to access the same decentral protocol in terms of secondary markets. That I think would be a great vision for the future. Yeah,
I think that's an excellent point. Look, we've only scratched the surface on a number of topics, and I've still managed to run over time. So apologies for everyone for keeping you up so late. Look, we've shown the challenge and the opportunity in building a more connected global crowdfunding ecosystem today. I want to hand back to Andrew just to close off, if that's okay. But before I do, I just wanted to mention, I mentioned this right at the beginning, that we are hosting an event. GECA and EDFA are jointly hosting an event on April, the 8th to the 10th of April in Málaga in Spain. It's an in-person event. It's running alongside the International Conference on Alternative Finance Research. And it's there to continue these conversations that we're having here with platforms, with investors, with regulators and technology leaders, bringing them all together in one room. We're going to be running some really insightful workshops that are going to focus on platform UX, on secondary markets, which we've just been speaking about, and tokenization and other technologies, but also on developing relationships with academic researchers. So everyone who's joined today's webinar is going to receive a personalized invitation to Málaga. That will contain all of the details about the event, and we really hope that you can be part of that next step. So let me just pass back to Andrew to just say a few closing words, but thank you again to all of our panelists. From my perspective, it's been really insightful for me personally, and hopefully to all the viewers as well. So thanks. Back to you, Andrew.
Thank you very much, Andy. I just want to take a second to thank Andy, GECA, Karsten, and his multiple groups for putting this together. I think this is a very important topic, and I think it's moving in the right direction. It's not moving as quickly as I'd like it to see move, but I think everybody can be in agreement on this. But I do believe that having active engagement with regulators, policymakers, and politicians is the way you're going to move this forward, whether you're in the UK, the EU, or the United States. And it's very important to work together and discuss these issues, because some are the same, some are different, and we all benefit from working together on this important issue of enabling online capital formation. So thank you, all the panelists who participated in this. Thank you for everybody who is watching this today and who will watch it in the future. And please feel free to reach out, connect with me on LinkedIn, and hopefully we'll all talk soon.
Thanks, everybody.